Donald Trump has doubled down on his Canadian steel and aluminium tariffs, hammering global markets again, who are nervous about trade wars. And Japan's GDP is revised down, but strong wages should keep the Bank of Japan hiking. That's coming up in our 5 Things in 5 Minutes on Wednesday, March the 12th. And then in today's bonus deep dive interview, ANZ Economist Dhiraj Nim explains why India's inflation rate doesn't look to be a problem for further policy easing.
We think that inflation for the month of February is likely below 4%. This gives the Reserve Bank considerable latitude to reconsider its monetary policy trajectory.
But first, in 5 and 5 with ANZ, Donald Trump lashed back overnight at a Canadian threat to impose a 25% surcharge on electricity exports from Ontario to the United States. Trump announced a doubling of tariffs on Canadian steel and aluminium imports to 50% in a social media post. As of 4 a.m. Sydney-Melbourne time, the Dow was down another 670 points, or 1.6%. The S&P 500 also down another 1.3%, and the Nasdaq fell another 0.9%. Inflation fears drove the US 10-year Treasury yield up 3 basis points to 4.23%. Here's ANZ economist Bansi Madhavani from London on why markets are reacting so badly to Donald Trump's topsy-turvy tariff moves.
Look, markets are already concerned that US's growth exceptionalism is fading. The prospect of renewed tariff concerns injected a fresh degree of uncertainty about US's growth outlook. The sell-off in equities intensified and Canadian dollar specifically fell to a 1-month low following the news.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was down 0.6%. The euro was up 0.9% at $1.9.28 US dollars. The Aussie dollar was flat at 62.83 US cents, and the Kiwi was up 0.2% at 57.09 US cents. Gold was up 0.8% at $2,923 US dollars an ounce, and West Texas Intermediate crude oil futures rose 0.4% to $66.29 US a barrel. Number 2. There was a slight dip in the ANZ Roy Morgan Australian Consumer Confidence measure last week, 0.8 points to 86.9. ANZ economist Sophia Angala says while the 4-week moving average is up 0.1 points in the past fortnight, the series has dropped by 3 points.
Looking to where it was before the RBA cut the cash rate in February, it is still nearly 2 points higher. So that decline that we saw last week could be driven by the tropical cyclone Alfred and its impacts on southern Queensland and northern New South Wales. Looking to the state confidence data, we saw that Queensland's consumer confidence fell more compared to the other mainland states.
Number 3. Sophia says offshore economic news might also be feeding through to local confidence.
Another driver to that decline as well could be uncertainty about the global economic environment, as households' confidence in the 5-year economic outlook fell 3.5 points last week, and it's actually now sitting below the average that held over the second half of 2024 after we saw the introduction of those stage 3 tax cuts. Meanwhile, confidence in the 12-month economic outlook for the economy also fell over 3 points.
Number 4. Australian business confidence dropped by 6 points in February, according to NAB's survey, while business conditions rose marginally. ANZ senior economist Adelaide Timbrell says businesses appear wary of the global situation as well.
Escalating global trade uncertainty has certainly hit US business and consumer confidence and maybe bleeding into a little bit of deterioration in Australian business confidence. Because when we look at the conditions, nothing has really changed. The capacity utilization rate is only down by 0.1 percentage points. Labour costs are looking very similar. Retail price growth is looking very similar. Capital expenditure is looking a little better. Forward orders are looking similar. There's nothing in what businesses are saying about their operations that points to a reason to be lower confidence. So that means it's likely something external, which we would consider is most likely global trade.
Number 5. Japan's December quarter economic growth was revised down from a preliminary annual rate of 2.8% to 2.2% yesterday. But ANZ FX analyst Felix Ryan says other data, including January base pay earnings, up 3.1% annually, and that was their strongest since the early 90s, points to the Bank of Japan still normalising policy through 2025. That means higher interest rates.
still looking like that wage pressure will come through, and that will of course flow through onto services inflation as time goes by and as that persists too. So we still have our view that we'll see 2 more rate hikes from the Bank of Japan this year in Q3 and Q4. So still that's a fairly cautious degree of normalisation, but again, definitely looking like it's going to happen with that strong consumption data there, and also very firm evidence there of wages rising as well.
Felix Ryan there. Now, in part 1 of a bonus deep dive interview on India's economy, ANZ Economist Dhiraj Nim explains why India's inflation outlook should help the Reserve Bank of India to cut rates again this year.
So a bit of backdrop, India's inflation problem so far was a food inflation problem, and even within food, it was largely vegetable prices which were out of control. However, in the last 2 months, because the fresh crop hit the markets and harvesting of the last season's crop was actually quite healthy, vegetable prices have suddenly eased dramatically, in fact, over the last 2 months, falling by about 14% in February by our estimates, on top of around a 15% decline in January. This means that the food inflation constraint on the Reserve Bank of India has eased considerably just in a span of 2 months. We in fact think that inflation for the month of February is likely below 4%, and 4% is the target of the Monetary Policy Committee. So this gives the Reserve Bank considerable latitude to reconsider its monetary policy trajectory, because this sudden fall in inflation means 2 things. One, that the entire inflation outlook will have to be reset, which means the Reserve Bank of India may have to cut its inflation forecasts for FY26 average by about 20 to 30 basis points. And at the same time, this means they would actually meet their target 4% on a durable basis much sooner than previously expected.
How many more times should the Reserve Bank of India cut?
We have 2 more rate cuts penciled in by the RBI in the April and the June meetings, 25 basis points each. The risk is that the rate cutting cycle could be longer and deeper if growth actually slows to about 6%, way below potential, which is around 6.5% to 7%. The caveats to this view is that we will need to watch out how weather plays out, because if weather is inclement yet again in 2025, then food inflation may rise again, tying the hands of the RBI from a monetary policy perspective. The other risk, of course, comes from the exchange rate, the depreciation in which can cause imported inflation risks. But we believe that at the moment, the disinflation in the food CPI is actually quite overwhelming, and it will offset potentially any increases in imported CPI over the next few months. So creating that space for the RBI to sort of remain on an accommodative path as far as cutting the policy rate and liquidity injections are concerned.
Why might the RBI have to add to that with liquidity injections?
Interestingly, even though the RBI cut the policy rate by 25 basis points in February, for the most part of the last month, the weighted average call rate, the interbank call rate, actually remained above the revised policy rate. And that was because the banking system liquidity was in a persistent deficit. Now, what it means is that the rate cut was not effectively transmitted into the bank rates. And that is a problem, because that means insufficient stimulus to the economy despite monetary policy making a pivot. Therefore, the Reserve Bank of India will have to continue injecting durable liquidity, at least, for example, till the outflows are continuing from the Indian economy, to prevent banking liquidity from impeding the transmission of rate cuts to the economy.
Dhiraj Nim there. And tomorrow, Dhiraj looks at how the RBI's ability to cut rates should also be helped by GDP growth falling below potential this year without further policy support. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, March the 12th. Catch you tomorrow with analysis of what US inflation data tonight could mean for rate cuts in the world's largest economy. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.